Let's bring in our next special guest, PIMCO Managing Director Neel Kashkari. He also, as you know, ran the TARP program in the waning days of the Bush administration. Before that, he was an executive at Goldman Sachs. And Neel, I know you're looking for opportunities right now for PIMCO. Your boss, Bill Gross, out saying today he doesn't think this deal is credible, this debt deal in Washington. What do you think of it?
Well, I think it accomplished the immediate objective of avoiding a default, raising the debt ceiling, allowing the U.S. government to fulfill its obligations. So that's the good news. The bad news is it just kicks the can down the road. It avoids making any hard choices and does not put us on a path to long-term fiscal solvency. Look at the past year. We had a bipartisan compromise that was celebrated last December, but no one had to make any hard choices. Then in May, we had a continuing budget resolution. No one had to make any hard choices. And now, once again, Congress is 3 for 3. No one has to make any hard choices. They're, announcing a big headline number. No one's touching entitlements. No one's touching tax reform. And we're creating yet another commission. I mean, do we really need another commission to realize that we just need political courage to make hard choices? So it avoids a default, which is good, but it doesn't actually solve the problem.
Yeah, and you've been vocal about this and entitlement reform for months now. I remember talking to you just last year about calls that you made for cuts. Do you trust, as you just said, why trust a committee to actually go through with $1.5 trillion in decision making? But what do you think we do end up with here? Just trimming of the fat around the edges?
Unfortunately, I think so. I think right now most politicians in Washington are singularly focused on their own reelection. I think that's true for the president. I think it's true for Republicans, and I think it's true for Democrats. And so everyone is united in not wanting to make any hard choices that they'd have to explain to their constituents and jeopardize their reelection prospects. And so, unfortunately, my best guess is that we're not going to see any substantive action on really reforming these programs until after the next presidential election. But as you know, Margaret, there's always another election on the horizon. And so until we have some actual leaders who are willing to lead, we're all going to be stuck in limbo, and this is going to be hanging over our economy for the foreseeable future.
But even if it's not just a matter of leadership, you've said in the past, that TARP program was only possible once people felt crisis. It wasn't just talked about in theory. They looked at their trading screens, they looked at what was happening on Main Street, and they were utterly terrified. Short of absolute crisis like that, what would actually bring about those forms of entitlement reform? Are we having to look at revenue raising and taxes going up? Are you ready to say that that is something that needs to happen?
Well, I think everything needs to be on the table to actually solve this problem and come up with a grand compromise. I've said to you before that for 30 years our economy has taken on more and more debt. That debt fueled consumption, it fueled spending, and eventually we had a debt-induced crisis. Now we need to restructure our economy towards savings and investment, away from borrowing and consumption. And so pro-growth tax reform, I think, should be on the table as part of a grand bargain. But if we just go back in our history a few decades, President Reagan, with Democrats in Washington in control of the Congress, managed to reform Social Security, managed to pass massive tax reform and immigration reform, each of which is very controversial. And so our political system is capable of making hard choices, but it requires real leadership in Washington, not just looking at the next election or the next poll to see what's going to be popular.
What does pro-growth tax reform look like to you? Is that means testing Social Security? Is that changes on carried interest? Specifically, what is least damaging to economic growth?
Well, to me, remember, when government taxes an activity, society gets less of that activity. So we tax cigarettes and alcohol, which makes sense, so people smoke less and drink less. Now we want people to work and save more, and yet we tax income and savings. So a very provocative policy, though not very realistic politically, would be to reduce income taxes and replace them dollar for dollar with consumption taxes, which could reduce consumption and increase savings and investment. Now, again, that's hard to pull off politically, but that's an example of pro-growth tax reform that could facilitate our adjustment towards a savings and investment society rather than a borrowing and consumption society.
That's a massive architectural change. But short of that, Bush-era tax policy, should they be expiring? Should we see taxes on carried interest and those things?
Honestly, I think everything should be on the table, including those things that you just mentioned, including means testing. I'm very fortunate sitting in my job that I have. I'm able to save money. I'm not likely to need Social Security or Medicare when I retire, even though I've been paying into these programs my entire adult life. So I think a reasonable question one should ask is, should I get these full benefits? And so means testing, although both Democrats and Republicans seem to hate means testing, to me it's an obvious part of the answer that should be on the table.
Do you think that the U.S. should see its credit downgraded? Not will it, but should it?
I think the economics suggest that. If you look at all of the unfunded liabilities, all of the promises that we've made, whether it's Social Security, Medicare, Medicaid, et cetera, out into the future, it does not bode well for our own fiscal situation. Now, the question is, can our political process actually get its act together and address those issues? So these are liabilities that we can reduce if we get our political system more functioning. And so I don't actually think we will get downgraded. I think that there's a risk. I think that this deal that the Congress is passing right now will take off some of the pressure and give S&P and Moody's breathing room so they don't have to downgrade. But I think if we don't actually make major structural reforms to get our economy growing again and to reduce our massive entitlement obligations, then I think we will have earned a downgrade, and then it will eventually happen.
Yeah, Bloomberg ran the numbers, and with this deal, debt will be 76% of GDP by 2020. Without these cuts, it'll be 85% of GDP by that same years. Do you think that a downgrade would matter? I mean, we saw panic when you saw downgrades in Europe, but that was really a question of solvency. Here in the United States, does anyone truly doubt the United States' ability to pay its own bills?
Well, it's a very complicated issue, and no one knows for sure. But oftentimes, financial crises can get triggered when the markets believe something, they make investment decisions based on those beliefs, and then those beliefs are proven to be untrue. So look at the housing bubble. For decades, people around the world, investors, banks, consumers, believed that home prices in America could not fall. We made massive investments based on that assumption. When that was proved to be wrong, markets adjusted violently as people tried to accommodate those new risks that they took. Now realize U.S. Treasury bonds are literally defined as the risk-free financial instrument that underpins the entire global economy. If we wake up one morning and all of a sudden people realize, well, wait a second, they're not risk-free, we've taken on more risk than we realized, that could trigger a new financial crisis, and that could be really destabilizing for the global economy. Compare it to Lehman Brothers. Lehman Brothers had about $600 billion of liabilities when they went into bankruptcy. People thought investment banks would never fail. And yet, U.S. Treasury bonds, there's around $14 trillion outstanding. And so it's not clear one way or the other, but it certainly is a risk that we need to take very seriously because U.S. Treasury bonds play such an important role in the global economy.
If the U.S. is not the gold standard, where does money flow?
Well, I think it'll be diversified globally. I think that although Europe right now is awash in its own fiscal crisis, because of its size, people will have to look to Europe as a destination for their capital, and certainly the emerging markets as well. If there were an acute crisis in the Treasury markets, I think the first thing people would do would be to move to cash, move out of risk assets, move to gold, move to silver, both paper and hard currency, so to speak. But then I think you'll see central banks around the world just much more diverse in where they're putting their reserves, not just putting them into the dollar.
Yeah, we see that move into gold happening right now. Thank you so much, Neel. Always great talking to you. Neel Kashkari of PIMCO.